Welcome everyone to Vested Interest. This is Shane back again for another Stock Pick of the Day video. It is Thursday. This will be the last one of the week, October 24th. We're going to take a look at Lear Corporation. This is actually out of the consumer discretionary sector. It is a automotive parts supplier. Before we get too far in the video, if you could do me a big favor, hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Hit that subscribe button. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever we put out any new content. I do this Stock Pick of the Day video series Monday through Thursday whenever the market's open. I also do suggestions from subscribers and viewers. So if you have a company like Lear you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down in the comment section down below. And don't forget to let me know what you think of the video. What do you think of the company Lear Corporation? Is it in your portfolio? Is it one you're watching? Is it one you're selling? Maybe you're part of the people who are driving this stock down today and we're on the selling side. Really appreciate all the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. And the last thing, if you could watch the videos to the end, watch time is one of the metrics that the YouTube algorithm uses to push the videos out a little further. And really appreciate everyone who's taking the time to do that. You guys are awesome. Let's keep rolling. Now, this is the Vested Interest Stock Screener. This is how I look at a company on a high level to see if I'm interested into adding it to my watch list. So we're going to run through this criteria at the end, see how this one stacks up. To make it onto my watch list, it must meet 5 of 8 of these metrics. If it was a financial company like a bank or an insurance company, I add in price to book using 1 as fair value, anything under 1 undervalued, anything over 1 overvalued. You can use price to book for any company stock, but if you are looking at price to book outside of the financial sector for things like banks, consumer discretionary sector like this one, industrial sector, information technology sector, the other sectors outside of financials, don't blindly use one. Compare the company you're looking at to other companies in the same sector making similar products, and then look at a range, maybe 2 or 3 companies like that, and see what the price to book, and then you can give you a range of where they are. And you should also be looking at other metrics, not just price to book, and it's just one of the many metrics that I do look at. And again, this doesn't mean that I am buying if it meets 5 of 8 or more. It means it makes it onto my watch list, and I do more of a deep dive into the company's financials, looking at their balance sheet, their income statement, debt to equity ratios, stuff like their margins. Are they growing over time? Is their revenue growing over time? Are they paying down debt? I'm looking at assets over liabilities. Do they have more assets than liabilities? I'm looking at things like their PEG ratio. I probably am comparing them as far as price to book to other companies. I'm looking at their price to earnings compared to other companies. A lot of other metrics you should be looking at. And if you don't want to do that kind of research, there's nothing wrong with that. You can still invest in the stock market. Warren Buffett recommends for the average investor who doesn't want to look at those kind of metrics or doesn't want to try to figure out the price, doing a discounted cash flow analysis, for example, to try to figure out the price you should pay for a company. Just invest into an ETF or index fund that tracks the S&P 500. That's what Warren Buffett would suggest. So something like VOO, VOO, that's Vanguard S&P 500 ETF. SPY is another one. There's several others out there that track the S&P 500 that you can just dump money into whenever you have some extra funds, weekly, monthly, quarterly, yearly, whatever your investing timeline is, and then just keep dumping money into it as maybe you learn how to do some research on stocks. And that's a way to get involved in the market while you're learning to be a better investor along the way. Now, back to Lear Corporation. You can check them out on their homepage at www.lear.com. That's www.lear.com. That is their homepage where I pulled this information from. Making every drive better. With over 100 years of experience, Lear has earned a legacy of operational excellence while building its future on innovation. Our talented team is committed to creating products that ensure the comfort, well-being, convenience, and safety of consumers. Working together, we are making every drive better. And really, their bread and butter is around seating. So you can go ahead and go into their homepage here. Lear built its business and reputation on seating with strong global OEM partnerships and the best team in the industry. We continue to disrupt the market with advanced technology and customized products for comfort, wellness, sound, and safety. And e-systems, right? Electrification, which everything's getting electrified now, advanced network architecture, and connected mobility. The car is going through a digital transformation. I mean, the newer vehicles, if you've seen them, everything's electronic. They even have a huge tablet now in the middle of the dash. And it seems like the tablets are only getting bigger and becoming more electrified in not only automotive, but everything that we do seems to be more and more electrically based. Our electrification, connectivity, and software innovations are enabling tomorrow's advanced driving solutions today. We deliver scalable power management electronics, software, and connected services solutions with the latest cybersecurity. Now, the reason we are taking a look at them today, down 6.5% on the day, we are talking about Lear Corporation. Again, this is a consumer discretionary company, and they're an automotive supplier, but they are out of the consumer discretionary sector. Closed out the day at $98.14. 52-week low as $97.51, as high as $147.11. So definitely right up against their 52-week low. Market cap of $5.531 billion. So this is a small cap company here, a beta of 1.45. So more volatile than the overall market. You can definitely see that volatility throughout the day. Price to earnings ratio, PE, pretty low, 10.52, $10.52 per share. EPS, earnings per share, just slightly lower than their price to earnings at $9.35 per share. Earnings date was today, so I'm assuming something around their earnings, negative earnings. They either missed the top line or bottom line or both, and possibly projections maybe downgraded, for example. But you would want to check out their earnings to see exactly what's going on. But something made them drop today, and I'm assuming it is around their earnings report. Forward dividend is $3.08 on the year. They are quarterly payers, so divide by 4, though we'll see that here in a little bit. Nice starting dividend yield of 2.93%. Ex-dividend date September 4th, so we're just past that. You would be, it looks like they paid out on September 23rd, so we're in October already. So you would be in line for the next dividend, though you'd have to wait a couple months to get it. Now, 1-year target estimate, $146.26. So as far as Yahoo Finance is concerned, they see it going, the stock price going back up, but not quite getting back to its 52-week high. They're just slightly under that over the next calendar year. Now, jumping over to the right, I like to look at dividend yield theory to see if a company is potentially undervalued. Quick reference, it's not the end-all be-all. To do that, we look at their 5-year dividend yield average, 1.89%. We compare it to their current 2.93%. And since their current, and over here 2.93%, same number. I know it says forward annual dividend. It's the same number. Since their current dividend yield is higher than their 5-year average, that speaks to undervaluation. These numbers are inversely correlated, and what that means is if the number's higher than their average, it's undervalued. If it was lower than their average, it's overvalued. Payout ratio is low. I like under 75%. They're sitting at 32.94%, so plenty of room to continue to grow this dividend over time, and it is definitely not in jeopardy of being cut, at least not right now. Going back in time, I like to look at free cash flow. So if a company has free cash flow growing, they typically will grow their dividend as well. It also means the company is probably pretty sound. They can pay down their debt. They can make acquisitions, reinvest back into the company, buy back shares, right? Raise dividends over time, which is what I like as a dividend growth investor. Hopefully you do as well. Going back to 2021 here in December, they had $85 million in free cash flow. 2022, big jump up to $383 million in free cash flow. 2023, a bigger jump up to $622 million in free cash flow. And it looks like the trailing 12 months, $649. So it looks like they're going to beat those metrics. I'm going to call that nice, steady, growing free cash flow growth. That looks nice. Repurchase of capital shares. They're also repurchasing shares, $100 million in 2021, 2022, $100 million again, same numbers. Looks like they just did the same thing they did in 2022. 2023, they raised that up a bit to $296 million. So not only is their free cash flow growing, but in 2023, they almost tripled their repurchase of shares. And it looks like so far over the trailing 12 months, they're continuing that repurchase of shares as well. Now, jumping over to stockanalysis.com, this is another source that I go to for information. You pick any sources that you like, but I do recommend more than 1, 2, if not 3, so you can make sure the information you're getting is accurate and up to date. Now, they have 12 analysts that have taken a look at this. They call it a consensus buy. They have a low estimate of $114, which would represent a 16.07% increase from where it currently sits. Average estimate of $147.17 would represent a 49.84% increase from where it currently sits. And if it happened to hit their high estimate of $200, that would be a 103.63% increase. And all the while, you could collect that just under 3% dividend yield. Now, jumping into statistics here, I like to look at return on equity and return on invested capital to see how well the company is reinvesting its capital back into itself. And I like 10% or better for both of these metrics. Now, return on equity, ROE, is at 12.56%, so that beats the 10% I'm looking for there. But return on invested capital is pretty low. It's under the 10% that I like at 7.95%. I'd like to see that higher. EPS growth is another one I look at. I like 5% or better forecasted over the next 5 years. Their earnings per share growth is forecasted at 22%, so that beats the 5% I'm looking for there. And I like to throw in revenue growth. It's not one of the metrics I look at as part of the screener. It is whenever I do more of a deep dive. So, and it's right by EPS whenever I look at this online, so I don't mind throwing it in here. They're projecting revenue growth to 3.34% over the next 5 years, so decent revenue growth. Now, as we stated here, we're going to look at their history real quick. They are a quarterly payer. Payout ratio 32.98%, again, under the 75% I like. Now, I don't like this. No dividend growth, NA, right? They haven't grown their dividend in a while. Buyback yield is positive, so whenever they are buying back shares, they're doing it efficiently, and shareholder yield is positive. Very nice shareholder yield, actually, 6.35%. They do pay out on the March, June, September, December timeframe like most companies do. Now, going back in time to 2022 here, you can see they were at 77 cents, and they have not raised it over the last several years. Actually, I think it goes back even further. I think it was 2018 or 2019 when I looked at this was the last time they raised it. They did raise it up significantly from 35 cents to 77 cents. I think it was 35 cents, may have been 38 cents to 77 cents. But again, multiple years now, 2021, 2022, 2023, 2024, they have not raised their dividend, and I do not like that. With such a low payout ratio, it'd be nice if they did raise their dividend, and maybe that's why they're aggressively buying back shares, because they haven't been raising their dividend. So it'd be nice if they started raising it, even if it was 3 to 5% a year, would be better than nothing. All right, let's check out the screener, see how this one stacks up. Understand the business, check there. That's where we start with all companies. We go to their homepage, see what they do, what do they make, the products they make, how are they making their money. That's where you should start as well. Growing free cash flow over the last 4 years into the future. Yes, we did see growing free cash flow. Growing dividend, no check there. Dividend payout ratio under 75%. Yes, it's under 40%. It's under 35% really, so check there. Dividend yield theory says it's potentially undervalued, and not only potentially undervalued, but significantly undervalued, at least according to dividend yield theory. Buy below current cost basis or than 15% of a 52-week low. It is not in my portfolio, so it can't be under my cost basis, but it is right up against their 52-week low, so it's within 15%. Check there. ROIC and ROE greater than 10%. Now, return on equity was, return on invested capital was not, so no check there. It's got to hit both of them. And earnings per share growth over 5% projected over the next 5 years. Check there. So that's 1, 2, 3, 4, 5, 6 of them. Now, this is not currently on my watch list. I may do a little bit more of a deep dive into this one. I am going to add it to my watch list. It does look interesting, especially being out of the consumer discretionary sector. I actually, when I first looked at this, thought it was out of the industrial sector, but out of the consumer discretionary sector, this is one that I'm going to do a little bit more of a deep dive into. It's not one that I've looked at in the past. Let me know if this is a company that you have ever reviewed in the past and what you think about it. Love to hear from you in the comment section down below. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So drop a comment down below. Let me know what you think of the video. Let me know what you think of Lear Corporation. And if you have any other companies you'd like me to take a look at in the Stock Pick of the Day series, drop them down there as well. Any questions you might have, don't be afraid to ask. I will try to get to them. If not today, sometime in the future. I do try to answer all the questions. Now, I am starting to get more questions and more comments, so it takes me a little bit to get to them. Don't think I'm ignoring you, and if I don't get to it, that just means I haven't come back to that comment or that video in some time, and I may not get to it, so I apologize. But as the channel grows, it's harder for me to get to every comment, but I am trying to watch the comments and especially focus on the ones that drop suggestions or make specific questions and answer those ones at a minimum. Well, this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing during educational and entertainment purposes. Investing involves risk. You can lose money. Should never invest any amount you're not comfortable using. Always do your own research. Invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.